Hey there, it's Mitch Goldberg. You're watching Be the Boss of Your Money. We're just getting started. We've got a few things to talk about. In particular, this market economic statistics that are coming out have been nothing short of just phenomenal. So I don't want to get into hyperbole, but the way the market feels right now and the way earnings are coming out, and the way some of the economic stats that I follow are coming out, I mean, it almost feels like we're starting a whole new bull market rally. And I've been saying this for the last few weeks. You could, there's good reason to feel bulled up. The last time I said it was in yesterday's live stream. So I want to go into why I feel this way. Of course, the most important thing is investing according to your risk tolerance, time horizon, and financial goals. So no matter how bulled up one may feel, you always have to have the expectation that there could be a substantial decrease in the market, and that could throw off your plan. So you have to make sure you invest accordingly. So let's get into this. This is Thursday's edition. It's always our quickest edition. We kind of go through a quick update, market wrap, and man, oh man, I say this every Thursday. How is it Thursday evening already? So let's roll the quick intro, and we're going to get into it. Here we go. And we're back. My name is Mitch Goldberg. You're watching my live stream / podcast. It's called Be the Boss of Your Money, because it's all about personal finance. If you know about personal finance, if it's something that you can understand, improve a little bit, work on, you'll be the boss of your money instead of your money becoming the boss of you. And it's very easy to happen. You always hear about people, they get into financial issues, debt, just things spiral out of control. And people don't always, they don't always understand exactly why. So that's what the show is all about. And I want to, it's not just about investing, but I think investing is at the forefront. And to me, investing is one of the more interesting, fun parts of my career. And I like to get into this stuff. But let's talk about a couple of things, because there's reason to be pretty optimistic. And I know, we're all watching the battle in Congress over stimulus between Biden and the Democrats and the Republicans to get a very big stimulus package through Congress. The Democrats proposed a $1.9 trillion stimulus proposal, which they feel they could use a technique called reconciliation to push through just by a majority vote, which they would have if they get every Democratic senator, all 50 to vote for it, and then Kamala Harris, Vice President Harris with the tiebreaker, 51 to 50 Republicans. So that would do it. But I still think Biden is trying to find a path forward. He's proposing $1,400 checks to couples who make under $150,000, individuals under $75,000. It looks like he wants to keep that $1,400 check, but he's willing to go lower on the income threshold. Maybe $50,000 a year, $100,000 a year for a couple, that sort of thing. We don't know all the details yet. It's all being ironed out, and that's created, I would say, last week and the week before, just a hint of uncertainty. But that's already going away, because we're going to get something. I mean, the $1.9 trillion stimulus, it might be a little bit less, and that's okay. If it's going to be a lot less, then we get into reconciliation, and we'll get it. The spending will be good for the market. I know a lot of people don't like that, but that's we talk about personal finance. So I want you to have good personal finance. Don't go into hock up to your eyeballs for consumption. Unfortunately, the government's doing that with the expectation that we'll get through this pandemic-induced deep recession that we find ourselves in. Even at this point, we still have more job losses. If you just to start today, we have more job losses than we did now through the entire Great Recession, just to show you how bad things are. But the title of today's stream is seeing the good things in the economy, and also I should have said in the stock market. So let's take a look at a couple of things, and then you'll see for yourself where I'm coming from and why I feel the way I do. Way I feel the way that I feel that I do. Let me just change a couple of things up on my screen. All right, look at that. First of all, let me get myself in here. All right, here I am. You see me? Upper left-hand corner. Maybe I'll go to the right this time. Upper right. Yeah, that's better. I feel like you could see me better over here. Hello. Hello. Okay. S&P 500 jumps 1% to a new record high, posts its fourth positive day in a row. Does that sound like a bear market to you? Because last week, we had our first rough couple of days since last October. So it's just about 4 months. We got through that pretty quick. There was a lot of confusion and people worried that the short sellers being taken out in body bags last week, maybe that's a little too much hyperbole right there, but that's where we used to talk, but we can't say things like that anymore. You saw the short sellers just lose a ton of money, and people thought that it would create a market accident, whereas a bank or a clearing firm would be on the hook for massive losses, and that would spread to other financial institutions who would be responsible for those losses, because everybody's responsible for a loss, and if you don't pick it up, then the next person or thing is responsible, then the bank. And if the bank has a loss, then there's another bank in line that loaned money to that bank that could have to take the loss. I mean, yes, banks have reserves and things that they can do to protect themselves. By the way, if you're watching this right now in the live stream, if you have any questions about what you're watching right now, what we're talking about, or anything with personal finance, hit me up with your questions in the comments. I'd love to hear from you. If you're watching this in the replay, certainly there too. I want to thank the new YouTube subscribers out there. I see you guys coming in, and I really appreciate it. If you want to reach me through YouTube, I know it's a little quirky thing of the regulatory bodies that I have to navigate, but I have to turn off the comments for YouTube. So if you want to reach me on Instagram at Mitch G at InstaMitchG. Connect with me on LinkedIn, Mitchell Goldberg, or send me an email, mgoldberg@clientfirststrategy.com. I would love to hear from you. So getting into this, S&P jumps to a new record high. Does that sound like, we're just, the S&P and NASDAQ, they're up about 4% on the week this week. So whatever we had last week, forget about it. That was a reason to take some profits, a little bit of a scare because of the short selling activity, the short squeeze that took place with GameStop and a handful of other stocks. That's pretty much past us. Okay, what you have left in its wake is some congressional hearings and maybe people in Congress trying to understand what went on. I can explain to them what went on in like a minute, but they just don't seem to understand how the markets work. And I feel like they're pandering. They're like, "Oh, how could you do this, Robinhood, and stop the trade?" Are you pandering to the Robinhood customers, or do you really know what the rules are? Because the rules of the industry is financial institutions have to act to protect themselves too. And if people are shorting GameStop or buying GameStop and not paying for the trade, and there's losses, Robinhood's on the hook. That's why they had to raise billions of dollars very quickly. It was a pretty touch and go situation for a few days, but we're pretty much through it. Okay. My friend Ron is out there. Ron, you've become like my advocate. You're like my audio visual guy. I have to do you a solid one of these days. We should actually talk on the phone one of these days. All right. But looking and sounding good, my friend, I want to know, how does Revolut and their type of virtual credit card facility sit with existing investors having instant buying power in their pockets rolled over to buy shares? And do you think there's an advantage to having all this handled tech to hand, or do you think it's better to keep apps like these separate from your personal finances? Will it become a game changer as it propagates and moves potential and existing customers away from the? We got cut off there. It's a good question though, because I so the point is, the friction. I think I could stop sharing the screen now. Okay. The friction is going away in financial services. It's if you want to buy a stock, you used to have to, you call up a broker, you'd have to send a check in, 3 days to settle, you get your confirmation. It was, at the time we didn't think of it as a big process to buy or sell a stock, but today it's frictionless. People call Robinhood the stock market in your pocket, the market in your pocket. And it's you can tie your purchasing of stocks directly to your savings account, your checking account, and it's all mixed, and it gives us this instantaneous ability to buy and sell. And maybe there should be a wall between when you buy or sell a stock. Maybe there should be like, some kind of, mental filter. Before, we're supposed to think before we speak. That's how we have, it's like a filter. And maybe it's the same. I don't think we're going backwards. We're doing stock trades, investing online, instantaneous settlement. I think we'll have one of these days. I don't think that goes backwards. I think we're just going to keep marching forward. There might be some more regulatory hurdles to get through for the fintech community, but the public wants it. And I don't think we're going back. And look, people got burned. I just want to show you something that I was looking at before. You check this out. As soon as my screen comes up, okay? Check this out. All right. This is GameStop. Down $38 today. Any stock down 42% in a day ordinarily would be unusual. Ordinarily, that would be extraordinary. And that's just so unusual to see a stock drop by 42. But if you look where my cursor is here, it was 483 last week. So almost 500 to down to almost 50. The stock lost almost 90% of its value. And this is what people like me were warning about, and what the regulators worried about, that the little guy, the retail investor, who finally feels like they're empowered to invest and they're moving the stock, they jump in. And by the time anybody was talking about GameStop, it was over 100 already. For most people, probably over 200 or 300 when they saw it. And now it's down to 50. So there are a lot of people sitting with substantial percentage losses. I'm not saying they're dollar amount losses, depends on how much stock people bought. And by the way, loss is all relative. Some people losing $1,000 is a big deal, and some people losing $1,000 is like, they don't even blink an eye. So everyone's different. Anyway, this is just crazy with what happened to Robinhood. This is just one day. Let's take a look at the 5-day chart. This is the 5-day chart of Robinhood. That is just, let's look at the 1 month now. This is just, look at that whole V, that V, it was like an M. Let's call this an M. The whole M was just cut right off. And before this started, Robinhood was what, a $2 or $3 stock. It's based on fundamentals. I would say it's still too high. So this goes to your point, Ron, about your question. Is it too easy to do this? I think every generation has to make their own mistakes. When I was a youngster, that's when E-Trade and Ameritrade and MyDiscountBroker.com and all these online trading firms first came around, and that was a big concern. Is this going to be good for the retail investor? People were worried about exchange traded funds at one time also. that they would be bad for investors. And now you see that ETFs have overtaken mutual funds. So we're not going backwards. It's tough to say. I think once people learn, they get better, and unfortunately, everyone has to learn from mistakes. Mistakes are the best teacher. That's really my thoughts on that. So let me go on and talk to you about a couple of things. Ford ups investment in electric and autonomous vehicles to $29 billion through 2025. That's a short amount of time. Okay, that's a lot of money. And if you take a look at GE is in breakout mode. GE is basically looking to phase out. They say in theory or philosophically that they'd like to phase out gasoline-powered vehicles. Okay, we'll see something about like 2035, and it's 14 years away. Listen, 14 years for a transition that big is a pretty short. It's a pretty short amount of time. They want to phase out fossil fuel vehicles, but the point is, I want you to think of something like, what ESG investing is? That is environmental, social, and governance investing. It's a very big trend. Companies that don't just do well, companies that do good for the environment. They promote women and minorities into board positions. They're good stewards of the environment. That's what ESG investing is all about, and it's a very, very big trend. Do you think of Ford? Do you think of Ford and GM as ESG plays? And that's the interesting thing. These two companies are going from hardcore smokestack metal benders to being thought of as tech plays and ESG plays, and that's amazing. Ford, one of their biggest problems now is the F-150, the number one vehicle. It's the number one selling vehicle in the world. They can't manufacture enough F-150s, because they can't get enough semiconductor chips that go into the F-150. And now Ford is going to do a whole big project with Google. So let's go on a little bit. And UPS, by the way, Ford and GM are doing very well, and UPS had a terrific earnings report. So it's not just that they're benefiting from the work from home, stay at home trend where we're all buying everything on Amazon and UPS is delivering it. It's more than that. They've had terrific numbers. So did FedEx. All right. And then you take a look at this, and this is key. I spoke about this yesterday. Services, the Institute for Supply Management, their PMI, Purchasing Managers Index for services. That's the non-manufacturing part of the economy. Look at this little chart in the middle. You see that? The dip in 2020. And now it's going up to 58.7. It's higher now than it was before the pandemic. It's such a bullish thing for the economy. It tells you a lot. And up like 8 months in a row of growth in the service sector. That's not something that anybody expected now. And that's a really strong economic indicator. And then you look at manufacturing. Look at the dip in manufacturing. This is into the first half of the year. That's, March, April. And then it rebounds up to 58.7. Now manufacturing, the PMI for manufacturing is higher now than before the pandemic. It's at its highest level in over 2 years. So, and then you combine that again with the S&P 500 hitting a new record. And, what you have is other economic statistics coming out that are very good. The employment figures that came today, claims, they came in a little better than expected. Tomorrow is Jobs Friday, so we see the January jobs report. And, I think people are getting pretty bulled up about that, but jobs are coming back. So let's just wrap this up, and then I'll let you go for the weekend. All right. I see another comment out there from Ron. Let's just, wrap this up. The economy is hitting a pretty good sound place. And if you look at the numbers that came in earnings from Microsoft, Apple, Facebook, Google, Netflix, okay? You look at some of the industrial companies, some of the drug companies. It's not just that they had really good numbers from the fourth quarter when everybody thought that the fourth quarter would be a dip because of rising COVID cases. That rising COVID cases didn't slow things down. In fact, things appear to be accelerating. The only fly in the ointment is if we get a really good, strong, solid non-farm payrolls report tomorrow morning, where we create a lot more jobs come back than expected. The fly in the ointment for the stock market, and I know this is going to sound kind of funny, kind of backwards, but that could be a negative for the stock market, because if the jobs report is really strong, that could mean lower probability of getting a huge stimulus package through, right? So that means maybe Biden and the rest of the Democrats, they'd have to scale down the stimulus package, because it's like, well, if the economy is doing better, maybe we don't need such a strong stimulus package. So in a way, if things are getting too good, that could be bad for stocks because it's less stimulus. And then we have to watch what the Federal Reserve does, because interest rates on long-term rates like the 10-year Treasury are starting to move up. And once the 10-year Treasury hit 1% recently, it hasn't gone back. So those are the things we need to look at. Okay. The card issuers have massive presence on social media, unlike the banks. Yep, that's true. Listen, I think this highlights that companies like, especially Robinhood, they're at the center of it, but it's not just them. Credit card companies, investment apps, and advertisers, everyone, the whole purpose of advertising is to separate you from your dollars. I know somebody in advertising would be insulted. So the purpose of advertising is to make sure that you are finding out and discovering what you want to spend your money on, because you might not have known about it before. That's from the advertiser's point of view. But companies are using social engineering tricks in many cases, and I think Robinhood exemplifies this, to get you to spend more money and do things that go against your best interest for your own personal finance. And that this is not new. This has happened. It's been happening, forever. So, but just the social engineering techniques are so good that even for people who are strong-willed and think that they would never get caught up in that, they get caught up in it too. And it's not your fault or my fault if any of us do. It's that these companies have learned tricks to fool the human brain. It has nothing to do with your willpower or your mental acuity or your mental strength. It's just that when you're duped, you're duped. Okay, I'm going to end it here. I thank everyone for joining me. Thank you, Stacy. Good to see you. It's a beautiful picture, by the way, of you and your boyfriend recently. You guys were out to dinner somewhere on Facebook. Beautiful picture. So thank you. I'll see you Monday. If you have any questions that you didn't think of yet, hit me up in the comments. Reach out to me, mgoldberg@clientfirststrategy.com. Follow me on Instagram @InstaMitchG. I'm on Facebook, Client First Strategy, and my YouTube channel is Client First Strategy as well. Subscribe there if you want to catch up on little snippets, 30-second to 2-minute snippets that I pull from all of my long-winded live stream videos. Thank you for watching.